Hey everyone, welcome back to Corporate Decoder. Today we are diving into South 8 Energy's latest report. Let's see if they struck oil or just ended up with a big bill. This report reveals a company in transition, selling off its main business and trying to figure out what's next. What do they even do now? Let's find out. Before we get started, if you want clear insights from corporate documents, make sure you're subscribed. Join our Discord community, linked in the description below, to talk about this and all things business and finance. This is South 8 Energy's report for the quarter that ended in March of 2025. Keep in mind that the big event here is that South 8 Energy sold almost all of its stuff to another company, Gevo. So this report is kind of a last look before the sale really changed things. Let's get straight to the numbers. Right away, we see a big change. Last year, they had about $4 million in receivables or money they expected to get, but now it's zero. But don't get too excited. That doesn't mean the company is broke. Cash and equivalents jumped from roughly $4 million to nearly $23 million. This is because of that big asset sale to Gevo, which we already talked about. You can think of cash and equivalents as easily accessible money that the company can use right away. Inventory, the stuff South 8 had on hand to sell, is also down to zero from about $10 million. They probably included it in the sale to Gevo. Net property, plant and equipment, which is land, buildings, machinery, etc., is down to zero. This also went to Gevo. Overall, total assets went from about $104 million all the way down to around $40 million. This makes total sense. Remember, they sold most of the company. Let's check the other side of the balance sheet. Accounts payable, which is the money that they owe, dropped big time from $2.5 million to just $27,000. Long-term debt or notes payable is completely gone. No more long-term debt. Equity, which is kind of like the company's net worth, fell from $76 million to about $40 million. The company has made a distribution paying out the shareholders. So to recap the balance sheet, South 8 sold almost everything. They turned assets into cash, paid off debts and gave a bunch of money back to the owners. Now, let's look at how they did for the first 3 months of the year by checking the statement of operations. Our anti-revenue intention, $16 million from $34 million. This is because the period only includes a single month of operations. Cost of goods sold also fell. Operating income or loss is more important because it tells us how much money the company actually made or lost from its business operations. It went to $80, $34, $849, and $49. Interest income also jumped, but by far the biggest change is other income, jumping to $144 million due to the proceeds from the sale to Gevo. The net income skyrocketed to $126 million compared to a loss of $64 million a year prior. Okay, let's talk cash flows. Cash flow from operating activities turned negative and is now an outflow. Cash flow from investing activities, however, shows $93 million. So basically, the company sold and received $123 million cash. Cash flow from financing activities are outflow or negative, and they total $162 million. That corresponds to the distributions that they did twine on. So the bottom line is that they converted their business into cash. Here they just talk about how they count things, accounting policies, etc. So we'll skip ahead. This part talks about where the revenue came from, which is all the usual stuff like ethanol, distillers grains, corn oil, and so on. Here we see the 6-month ending numbers. They account for shipping and handling as part of the cost of goods sold. Basically, the money they get from customers to ship stuff is revenue, and the cost of shipping it is an expense. Derivatives are financial contracts that companies often use to protect themselves from price changes. South 8 use them for things like ethanol, soybean oil, natural gas, and corn. They basically say they are no longer doing that. Again, inventory has been transferred as part of the asset sale. The big picture here is they got rid of all of their bank loans. All they are debt-free. This section talks about commitments. Think of it like contracts and long-term deals they've made. They note that as a result of the asset sale, many of those responsibilities have been assigned. Related party transactions are deals they do with people connected to the company, like owners or board members. You have to disclose this because it can create conflicts of interest. Most of their revenue was coming from related parties in the pre-sale period. For the current report, well, this report acknowledges what is very obvious by now. The company completed the sale and, as a result, no longer runs its ethanol plant. Their future relies on a few factors they can't fully control, including whether or not they'll get all the money being held back in escrow and what they'll get for voluntary carbon credits. This section talks about things that happened after the quarter ended, but that could still be important. There is some minor money they are getting from redeeming their stake in a marketing firm off the bottom line here. South 8 sold its ethanol plant. It's sitting on a pile of cash, but the business doesn't really exist as an operating business anymore. The board will need to figure out how to manage and distribute its cash. The biggest risk is the uncertainty of the cash it is holding in escrows. We also don't know that are the regulatory risks with the carbon credit. Alright, that's our breakdown of South 8 Energy's latest filing. What's your take on these numbers and what they signal for the company's future, or what you would do as the board? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.